I think that capital that gets placed in 2026 is going to be very well positioned, despite the uncertainty, despite the challenges that we all face as investors. And it takes a little bit of guts to get out there and say, all right, now is the time to move. Warren Buffett's famous quote, when people are greedy, be fearful. When people are fearful, be greedy. And again, right now, I think a lot of the investment capital is cautious. And I think that that drives a lot of the opportunity I see in the marketplace.
Hey everybody, welcome back to another episode of Wealth Unfiltered. As you know, I'm Samantha Parrinello, your host, and today is the fourth episode in our series, Multifamily Market Outlook for 2026. My guest today is a favorite from last season. He is the Chief Analytics and Intelligence Officer for Marcus Millichap. That's right, I'm talking about John Chang. So welcome to the show. How are you, John?
Doing fantastic. How are you doing, Samantha?
I'm wonderful. I really appreciate your time today. I know our listeners are very excited about this series. One thing is, I was just thinking about how last time when we had you on, I really didn't dive into your background. And I think it's really important for everyone to hear about who you are and why I value everything that you say so much. So how about you dive into how you got to be where you are?
Wow. I guess if I go all the way back, my family was investing in real estate since I was very young. And I remember when I was 4 years old, walking through rental houses that my dad was buying and just, learning the ropes right from the very beginning. Then in 1997, I joined Marcus Millichap as part of the research services team that was really just being launched under the leadership of Hassam Naji, who is now the CEO of Marcus Millichap. And I just learned so much from him and had such it was so interesting and dynamic. And I realized how much opportunity there is in real estate investing and how it is so unique from any other investment class. And so I just continued to learn and worked on research and analytics for commercial real estate for years. Then I spent a few years running marketing for a software company and then for some residential real estate firms. And I rejoined Marcus Millichap in 2007 to head up the research services team. And I've been here ever since. So I have a fantastic team. We have like 25 people working in our research team, covering all the different property types. And we just have a very, very simple, great mission, which is providing insight and information to help investors make better informed decisions. And so it's a lot of fun for us. And there's always something happening that makes this job interesting.
Yeah, well, the reason I feel like I know you so well, even though we really have only met, I would say, a handful of times, is because we run into each other in the circuits of conferences. And you are very well known for speaking at conferences, for doing presentations, and probably why you're so good at podcasts.
Well, I do 25 or 30 speaking engagements per year, sometimes a little bit more. And so again, it's covering all different property types. I do a medical office conference. I do a lot of multifamily. I even do, retail and office and industrial. So I'm one of the few people out there who's really paying attention to all of the different property types and how they interact. There are a lot of analysts out there who are specialists in just one property type, multifamily, for example, and they're able to go really deep into that specific niche and get into the tight nuances. And on the other side of the equation, I bring a lot more breadth and context to the broader commercial real estate that I can then leverage into properties like apartments.
I love it. Amazing. Well, I think that's the perfect segue to jump right in. As you know, this is about the multifamily outlook for this year. And we're actually already almost done with the first quarter of 2026. So where we're sitting right now from what you've already seen, and then obviously what you guys have data projecting, where do you describe the current state of the market?
Complex. It's very, very different. The reality in one market is very different from another. For example, if you look back at 2025 and you look at rent growth in Chicago or Cleveland, there was rent growth around 7%. The vacancy stayed low. There wasn't a lot of movement, and it was steady as she goes. I did a conference in Chicago, and they were all doing high fives. They were so happy. Business is best ever. About a month later, I was in Dallas, and they were saying, "What's happened? Why is rent growth running negative? Why are we facing all these challenges? And when does this problem end?" And so it's a very different reality across different markets. At the same time, you look at the big picture, the macroeconomics, and they're very, very choppy, and there's a lot of uncertainty. What's going to happen with tariffs? What's going to happen with now? What's happening with Iran? These things create a lot of challenges for businesses and investors. A couple of weeks ago, I was literally on stage saying, "Okay, everyone, be careful because there could be changes. These tariffs are at the Supreme Court, and we could get an announcement anytime now." And literally, while I was on stage, it came out that they got rid of the tariffs that were in place from the Supreme Court. So it's just been very fluid this year. So as I look forward, there's some things that are definitely going to be positive for the industry. There's going to be definitely some challenges. There's a lot of opportunities that are being created in that period of uncertainty that I think investors can capitalize on.
Absolutely. No, I couldn't agree more. I think everyone is seeing how regionally there's just such a wide variety of what's really happening in the market. One of the things I wanted to touch on or ask you about is obviously, 2025 was just a few months ago. And there were some, I think, major fundamental shifts that we saw, things that we were unsure about. And as we close out the year and you look back at it, are there anything that you're like, yeah, I feel like this is actually going to be the same story for 2026? Or is there a defining factor that you're already seeing between the two?
Again, it's very fluid.
Yeah.
If you ask me, 30 days ago, I was looking at the numbers, and yes, there are some headwinds and challenges out there, but I do believe there's a lot of capital coming into multifamily. I see a lot of opportunity there. The cap rates have gone up, the cost of capital, the debt capital the prices have gone down, interest rates have come down, and I just see a lot of opportunity. But at the same time, just over the last, actually today, we got new jobs numbers, and the jobs numbers from 2025 were worse than I anticipated, and they were already not good. So
Right.
I worry about what's happening with the employment in the United States. Now, there are markets that are going to outperform, and there are markets that are going to underperform. And so being able to discern where is there enough momentum to drive the economy forward on a metro by metro, a local basis is going to be key. But literally, we just got some more revisions to December, which took the job creation for the latter part of last year into negative territory. And I think that causes some investors to take a pause. It will slow down household formation, which I think is going to be a real challenge in a lot of the Sunbelt markets that, are really dependent on creating jobs and bringing people in and migration to the market. And I think that's all slowing down. And in a lot of those Sunbelt markets, there was a lot of development. And we had anticipated that space would be absorbed in the year two at the outside. And now it's leaning more towards a two if we don't see a revival of the job creation. So there are headwinds. By the same token, there are markets that are continuing to plow forward and generating good results. They didn't overdevelop. The vacancy rates are stable, and the rent growth is still positive and will continue to be so because the demand for rental housing, the demand for apartments is really strong, and it's going to continue to be steady because the cost of home ownership is so far out of reach of so many people. And that affordability gap is a huge barrier that's going to keep more and more people as rental households for much longer. We have seen a slowdown in the absorption of new household creation, but that's pent-up demand. And we see in we see in the news that the unemployment rate of recent college graduates has been going up, right? So a lot of those people don't go out and rent an apartment today, but at some point that breaks free, And that is all pent-up demand that comes out back into the market, and then will boost those absorption numbers, and we'll see a strong recovery right then.
One of the things that you just had mentioned was, that you're still seeing that in the Midwest area and some of those markets that there's a lot more like rent growth and more stability than in the Sun Belt. In those areas, are you all still seeing new developments coming online because of the housing shortage issues and demand?
Not really, because we kind of already moved through the development window, if you will. So normally, yes, you would. But the thing is because of tariffs and immigration policy, and also the construction lending, the cost to build right now is going up. And because of that, the opportunistic developers who would normally have gone in and tried to take advantage of these opportunities are holding back because they don't have a reliable source of labor. They don't, and their cost of materials have increased substantially. So making the math work right now is hard. And quite frankly, a lot of the lenders really don't want to loan money on construction right now. They know on a macro basis, we overdeveloped. This is a short-term issue. We still have a housing shortage, but we have overbuilt specific markets and made it challenging to get that all filled. So the lenders are really kind of holding back on that lending for construction, even in markets where they still technically need more apartment units.
And you also mentioned, that there's obviously the affordability challenges, and there's like a wide gap right now in the single family market versus the rental demographic. What is the data showing you for how long we should expect that to continue or even widen?
And in terms of how long it will take for the household formation to recover, or
I think twofold that and for like pricing to not be so vastly different between single family and rentals.
got it, got it, got it. Okay, two different issues. Household formation is going to be a byproduct of job creation. So at some point, right now, last year we added what 100 and we just got new numbers today, but I think it was like 115,000 jobs for the year, 116,000 for the year. So that's really, really low. We were doing that in a month, a year ago. And so this is a real downturn to be able just be adding that many jobs in a whole year. And that's a headwind for household formation. That's going to slow down that pace. In terms of the affordability gap, which is really significant, it's about $1,200 difference. The payment on a median priced house today, including principal, interest, taxes, insurance, assuming a 10% down payment, the monthly payment on that is just over $3,000. And the average apartment rent in the US right now is about $1,850. So that gap is about $1,200, and that is a big hurdle. That is a big monthly differential. In addition, because of the qualifying criteria for the debt to income ratios based on Freddie Mac underwriting, only 29% of US households can qualify for a mortgage today on a median priced house. And historically, if you look back into, 2010 through 2020, that was close to 50%. So housing affordability for home ownership is very challenging. And in order for that to change, in my opinion, the average mortgage rate on a 30-year mortgage will have to push down to somewhere around 4%. And we're somewhere north of 6% right now. And the reason is because so many people have locked in mortgage rates at whatever, 2.5, 3.25%. And they don't want to give that up and go buy a new house and get a 6% mortgage. So they're staying in that house for longer. Those are all the entry-level homes, and they are not moving out. So the inventory of houses in that price range is very low, very hard to buy. Prices keep going up because there's a shortage. And until you lock that traditional churn in the households, typically people only lived in a house for 5 to 7 years, and then they would sell it and move up into the next house. That has completely stalled over the last 5 to 10 years. And because of that, you have that housing shortage. The builders can't build a house for $400,000 in most markets.
Right.
So you end up with this shortage, and that's going to continue to be a challenge until interest rates drop sufficiently to unlock that market and convince people to start that regular momentum in that marketplace that we just haven't seen in years. So I don't see that happening anytime soon. And again, that's part of why I believe the multifamily model is so strong. That investment opportunity is so strong over the long term because I think that gap is going to stay very wide. And I think a lot more people are going to stay in rental housing longer. And at some point, once the employment market picks up, we're going to see a surge of demand similar to what we saw following the pandemic, where a lot of those households were unlocked and we saw this huge rush to go rent apartments that will bolster the market.
Absolutely. So you mentioned a little bit about occupancy and those, occupancy level being up because of that, the demand levels. So are there any trends you're specifically seeing already this year where it's maybe a lot different than you would have anticipated, or what are you guys seeing for rent growth and occupancy levels?
My team did an analysis comparing Sunbelt markets against non-Sunbelt markets, right? Because you have these real overdevelopment scenarios in a lot of the Sunbelt markets that you just don't have in a lot of the northern markets. And so what happens is the vacancy rates in the Sunbelt are dramatically higher than what you're seeing in the non-Sunbelt areas. And also in the Sun Belt, you're seeing the Class A cannibalize your Class B, and then they cannibalize the Class C. So the challenges of filling up apartments is significant. The use of concessions in the Sun Belt is elevated. I'm hearing 2, 3, in some cases even 4 months of free rent on a 1-year lease.
Wow.
And that is a huge headwind. Conversely, in the non-Sunbelt markets, you have, a 5.5% vacancy rate for Class A, a 4% vacancy for Class B, and a 3.6% vacancy for Class C. So there's a very, very different dynamic. And just so I have the numbers out there, the Sun Belt vacancy rates for A, B, and C are all around 6.5%.
Wow.
So there's this huge gap and a huge differential between the different market types and the different classes of property type that is creating this real challenge. So then when you flip over to the rent growth, your Class A rent growth in both the Sun Belt and the non-Sun Belt is marginally positive, kind of a 2% range. And even I think that's going to be challenged in 2026 as we burn off these concessions. Your Class B in the Sun Belt is actually still a negative rent. Same with Class C in the Sun Belt, whereas in the non-Sun Belt, you have 2.5, 3% rent growth in both Class B and Class C. So you have this really, really different dynamic depending on where you're investing and the markets and the supply and demand dynamics.
Right.
Now, people should, I believe the Sun Belt is an enormous opportunity because of these challenges, because those markets tend to create more jobs than the non-Sun Belt markets. And they're just being stymied right now because of uncertainty in the various policies that are in place. And so at some point, when the market turns, when the economy turns, when the job creation starts to ramp back up, the demand for housing in those markets will accelerate very fast, and you're going to see a dramatic change in the performance of those markets. It's going to be challenging up to a point, and then it turns and it starts to really gain momentum. And that's going to shift those values in those Sunbelt markets very fast as that transition happens.
What are you seeing right now as far as transaction volume? One of the things I noticed was I was seeing a couple of major transactions happening in the Sun Belt from some big players who are coming in and buying up portfolios or, communities. And I was kind of thinking the same thing. I'm like, man, like the Sun Belt seems like it's having some adversity. Instead of like going to the Midwest, I was trying to understand the logic there, but kind of what you're speaking to, are you seeing more of that as well?
Yeah, so overall transaction velocity has increased pretty substantially in 2025 versus 2024, about 18% increase in the number of deals. And that's a good boost. We're almost kind of back to the traditional normal. And by that, I mean, I took the average of 2014 to 2019 and I just said, all right, that's a normal market. Where are we relative to that? We're still slightly down in terms of multifamily transactions relative to that,
Mhm.
but we've been making a lot of progress. And so there's two camps of investors, right? There's the ones who are saying, okay, I want to play it safe. I'm going to go steady Eddie. I'm going to go up into one of these low development markets, clip my coupons and just roll forward. And then there's the investors who have a little bit more risk tolerance, and they say, okay, I'm going to buy in on this idea that this is a market that's having some challenges, but I'm buying right. I'm underwriting at the current dynamics of that market with the higher vacancy rate, the more concessions, the weaker rent growth. So I'm underwriting based on today's performance. And when that performance shifts, these values are going to rise very fast. So the different investor pools, depending on the risk tolerance of the capital and how much urgency there is, how patient that capital is, determines where they go. If it's an investor who says, look, I'm I don't want to be in this for more than 3 years, then you probably don't want to go into the Sunbelt. But if you're saying, okay, I'm waiting for that big hit, and if it takes 5 years, 6 years, 3 years, whatever, I know it's going to come. I just don't know when, but I'm willing to make a bet that when that happens, values will increase dramatically, and that's where I'm going to get my big payout. So different investors have different strategies and a different approach and different needs. And depending on those, there are opportunities on both sides of that equation.
And so far this year, have you seen that continued transaction tick up like you did in 2025?
The first quarter is looking like it's going to be pretty solid. I mentioned earlier that the interest rates have come down. So that's like the 10-year treasury has come down a little bit. But what the real big difference has been the lenders themselves reducing their spreads. We've seen it in terms of, the Fannie Mae and Freddie Mac rates. Those are down under 5% now. And you look at the revival of bank lending over the last year, which is really a big positive. They pulled back out of the market in 22, 23 when the interest rates were rising. A couple of banks went out of business, and they all sat back and held off on the market. They wanted to repair their balance sheets and so on, but they're coming back in. So the liquidity is increasing for commercial real estate lending, and there's more competition to place debt. So when you look at the actual lending rates and set aside the 10-year treasury and some of those things, the rates that the borrowers are able to get on real estate, they're actually the lowest they've been since 2022. And
Oh, wow.
so we had the cap rates go up, and we had the cost of borrowing come down, and that's creating a positive environment for investors. Now, that being said, there's a lot of uncertainty, a lot of risks. We keep messing around with tariffs. So we have this military action in the Middle East, and there's a lot of investors who are cautious when you have these types of things happening. So where we go in the month of March and April, I'm not sure. But structurally, from an investment standpoint, I believe that the momentum is going to remain positive. I've seen a lot more capital coming into the institutions. So when you look at the data on how much capital is being raised by the institutional investors targeting commercial real estate, that has been on a strong rise over 2025, and it looks like going through 2026, it's going to be strong as well. The stock market, there's a lot of questions about the valuations in the stock market. There's a lot of investors who believe that the stock market is kind of very, very aggressively priced, and it's time to take some chips off the table. And at that point, do you go out and do you buy gold at a record high price? Or do you go back and you go buy apartments or other types of commercial real estate, which have had a reduction in pricing over the last couple of years, and capitalize on that upside potential? And I do believe that there's a lot more capital that will be shifting over into commercial real estate as a safety play and an opportunistic play at the same time.
Amazing. Well, that actually leads me perfectly into my next question for you. So, investors are obviously looking at these trends, they're listening to you, they're listening to other resources. So, how do you feel like, based off of the current environment, they're adjusting their strategies?
Yeah, there's a cadre of investments that were made in 21 and 22 that took place when the market was getting overheated in commercial real estate. And the investors that have their money in those assets are moving more slowly. They're waiting for that capital to turn. still in a recovery process. But for the capital that's coming fresh to the market, or investors who are pulling money out of the stock market or other investments and reallocating it into real estate, I think that they're again looking at those two strategies. Do I go safe and I go into something that's going to generate a nice coupon clipper at whatever 6% yield or whatever it is for a property in the Midwest, 7% maybe, or do I go for that longer term, big growth opportunity that we see across all those Sunbelt markets? And I see investors going both directions. I mean, I talk to investors almost every day, and one of them will say, look, this pool of capital it needs to be safe. This is my client base. These investors, they're not that risk, they don't want to take too much risk. And I'm like, okay, well, then you want to be over here.
Right.
But there's other ones that are saying, look, I have patient capital that wants to maximize their yield over the long term. Where do you want to go? And that's when I start to get into some of these Sunbelt markets that do have steady or strong growth, that maybe has pricing that's come down. The number of bidders on an individual asset is lower. And those, I think, are some fantastic opportunities.
So one thing that I think really, really was a big role in the multifamily demand was our domestic migration trends that we saw over the last 3 years, pretty much since COVID, I should say, really. Are you still seeing Sunbelt markets leading that domestic migration, or has there been just a pretty, because I haven't seen a lot about the domestic migration lately, and I was just wondering where the current state is.
So those markets still lead, but the pace of domestic migration has slowed down significantly. So I was just doing an analysis on Texas the other day, and the migration to Texas is about half the level that it was a couple of years ago. But it was huge a couple of years ago. And in Texas, Dallas was creating hundreds of thousands of jobs. Now, our forecast for Dallas, for example, is to add about 35,000 jobs in 2026. Way, way down, but positive. So that migration to Texas is going to be slower. Another market, I live in Phoenix, Arizona, and we overbuilt this market. It's facing some headwinds. But when you look at key things like the TSMC, the Taiwan Semiconductor chip manufacturing plant, that ecosystem over the next 5 years will generate, in my opinion, this is not an official number, in my opinion, will probably create about 200,000 jobs over the next 5 to 10 years through that ecosystem. And that's going to be a strong driver for demand. It's going to drive a lot of in-migration to the Phoenix metro and ultimately generate results for those properties that are facing headwinds today. So I do believe, and you look at Charlotte and Raleigh and Nashville and Florida and the other parts of Texas, I think that story holds true for most of them, and that momentum will shift, and then you're going to see those returns come back into play.
I love that. Is there any markets where you're seeing right now that you would caution people to get involved with right now, or maybe play the waiting game?
No.
Okay, short and
Well,
sweet.
here's why. Here's why. Okay, if you look back at the last 30, 40 years of apartment cap rates, since 1990, cap rates have only gone up 4 times. All right. Two of them were because of the savings and loan crisis and the RTC. All right. That was back in the 90s. The third one was during the global financial crisis in 8, 9, 10. And then the third one is the last 3 years, since 2022, when the rates started going up. All right. So historically speaking, there are only 4 times that cap rates went up, and inevitably after that, they trended back down again. And that momentum is broad-based and will carry through the entire market. So I can't tell you when, but at some point, those cap rates will start to tip over and start to come back down again based on how they've behaved historically. And it has far less dependence on interest rates than most people believe. A lot of the times, they're actually moving in opposite directions. The interest rates are going up and the cap rates are coming down. And it actually has a lot more to do with the flow of capital into apartments. So As we see the capital flows shift, that's when we start to see those cap rates come back down again. It probably won't be 2026, in my opinion, but at some point in the not too distant future, 27, 28, 29, somewhere out there, those cap rates start to come down. And again, nobody should be investing in multifamily or any other type of commercial real estate with a short-term horizon,
Right.
right? They shouldn't be thinking in terms of 1, 2, 3 years. You need to really be thinking about, 5, 6, 7, maybe all the way out to 10 years in terms of your yield over the extended period, because those cycles are so much longer than other types of investments. But if you have that money that you're ready to set aside for a 5 year or plus cycle, I think the opportunities are fantastic. And that's true in Chicago, where you have very little development and actually fundamentals are performing pretty well. And that's true in Dallas or Miami, or even right now, Washington, D.C. is facing some headwinds because of all the government job losses.
Mm.
But at some point, those are recovered. You look at the last time we had a massive downsizing of the federal government, and over the next 10 years after that, it just grew. And so these things are cyclical. And the opportunity today is that we're at that point in the cycle where we're hitting that bottom. And again, I can't say how long we're going to be sitting there, but at some point we come out of that and that momentum shifts because we have a housing shortage, because people are going to be renting longer, because we have pent up demand that is accruing and will unlock at some point that the entire market shifts again.
So based on that, what kind of signals would investors be looking at to indicate to them that the market conditions are improving?
So, one of the things I measure is the uncertainty index. I keep track of that every month. They come out with a new number. We just got a number a couple days ago. That uncertainty index right now is probably the most telling piece of information out there. That's number one. Because when uncertainty is elevated, people are cautious. All right. And when there's caution, there's less activity. That's the first one. The second one is consumer sentiment. The University of Michigan consumer sentiment, not the consumer confidence number. I like the sentiment number better. Consumer sentiment right now is basically bouncing on the bottom. It's at the lowest. It's one of the lowest levels we've seen on history. Consumer sentiment actually has a correlation to apartment demand, space absorption. So when sentiment falls, people are less likely to form a household. They're less likely to go rent a new apartment. And when consumer sentiment rises, they're more likely to go out and rent. So that's the second number that I would be monitoring. And then beyond that, it's basic stuff like who's creating jobs, what kinds of jobs, where are the jobs, and you can start to then pinpoint. But those two metrics, uncertainty and sentiment, go hand in hand right now. And that's the trigger you're waiting for. And, again, a lot of this, I'm going to step out on a limb here. A lot of this is being driven by federal policy and the Trump administration in terms of not clearly articulating what is going to happen. All right. Whether you agree with the policies or don't agree with the policies, the one thing everybody I talk to agrees on is we don't know what's coming or when it's coming.
Correct.
And as a result, they're more cautious.
Mhm.
And so at some point, whether it's after the midterms, whether it's after the next presidential election, or some point in the future, when we have a change in the way policy is being handled to be more transparent and providing more signals about what's coming, then sentiment will probably start to rise, uncertainty will drop, and that's going to be the trigger point at which you start to see those household formations accelerate. You start to see more job creation. Companies right now, the job openings is way down because companies are being cautious. When they're less cautious, they're going to start hiring more, and that's going to support the growth of demand for multifamily.
That's incredible. I think that's really, really good information for our listeners. One thing that you actually kind of made me think of also is, okay, so those are people who are waiting, maybe trying to understand the market a little bit better. But when you think about what you're seeing as active investors right now, are there certain segments? Like, are you looking at in multifamily workforce housing being the best, or is Class A still the one that's thriving, or maybe it's BTR? Like, where are you really seeing the focus?
It's funny, I was at the National Multi-Housing Council conference in January, and I met with about 40 different investor groups over the course of 2 days. It was just speed dating, we were hammering through. But they fell into 2 camps, and about 80%, I would say, are looking for newer construction, newer units, Class A, B+, kind of, 1990s or 2000s construction and newer. And then there was about 20% who were saying, we're going to go for, workforce housing. We want value add. We want that 70s, 80s construction because we think that that's going to have the most lift as we go through that next turn. So it varied. Again, each investor has a unique strategy on how they want to play this. They all make sense. It's a question of how much risk and timing are they willing to face, and whether or not they're able to do value add easily or if that's a challenge for them. Right. So a lot of those investors looking at the newer stuff says, look, I don't want to deal with changing out all the air conditioning units or the appliances or any of that. We can do light refurbishment, but we don't want to do a heavy lift. And other investors say, look, I have an entire construction team at my disposal. I want those older properties where I can upgrade them and capitalize on that. Now, the opportunity for value add right now, today, is limited because you just don't have the rent growth to support it. But at some point in the future, when that demand is unlocked, when that pent up demand frees up and comes back into the market, that's where you're going to start to see it. And those workforce housing value add opportunities could be very good. But again, know your market. Different areas are going to be stronger for that, and other areas are going to be weaker. And in some markets, there's been a ton of value add over the last few years. So there's that opportunity for the upside is not as strong.
I was just going to ask you, was going to say for the two schools of thoughts, is there a correlation to one of them being more towards the Sun Belt or one being Midwest, or is there like a regional discrepancy of like why they're kind of focused on either the Class A or the value add?
To a degree, because in the Sun Belt, you have a lot more newer product. You have a lot more inventory that falls into that class. And so there's a natural lean that way. Also, some of these builders and developers have gotten into trouble. And there are unique opportunities to acquire those newer properties where those builders got out over their skis. I think there's also a little bit of potential for distress in some of those properties that they could show up where a builder just says, look, I got to get out from underneath this, and I need either capital to come in as a partner or I need to sell it. Then there's other markets like, for example, Southern California, where there's just not a lot of new development there over the years. And so you're relying on an older inventory property type and that value add proposition. Incidentally, I talked to some investors in LA that traditionally were buying in other parts of the country, and they are sticking closer to home. They're saying, hey, look, we haven't seen pricing like this in LA in like a generation. This is a huge opportunity. Another crazy one is New York City, right? Because of the policies that are being put in place in New York, there's a lot of fear right now, and the cap rates on properties there are pushing up towards 8% on a property in New York. Now, those properties, whatever, 10 years ago were like a 2 cap. Now they're an 8. Now, are they going to stay there? Maybe. Is it a tough market to operate in? Absolutely. But you can just see that this market is in a really weird place where there are so many opportunities that are emerging, and there's a lot of reluctance for some of the capital to get out there and get active, and especially the money that's still tied up in that 21, 22 vintage property that is slowing down that opportunistic investment. And again, I see that as the prime opportunity today because of the relationship between the mortgage rates, pricing, the cap rates, and the demand drivers that I see coming at some point in the future. So kind of going back to your question earlier, was there any place that I would avoid? And no, I think that they're all going to be good in their own way.
I love it. So I'm obviously going to ask you next year to come back to the show again because I get you on once a year and I love to see how you forecast the year. But what I want to know right now, my last question for you is when we sit together next year and you think about, okay, how did 2026 unfold? What do you think is going to be like the defining story?
Literally today, as I was kind of doing my prep work, I looked back at a slide I used in a presentation of January last year, and it just resonated with me. And it said, due to the policy uncertainty for the coming year, please take all of our forecasts with a grain of salt. And I think we're still in that boat, right? Look, a week ago, we were not invading, we were not bombing Iran. And today we are, right? And I hate to bring that up, but the point is that you don't know what's going to happen right now. And I think that's the nature of the challenge for investors over the course of 2026. As we look back a year from now, we're going to say, all right, it was a choppy year. It was very difficult to predict what was going to happen the next day, the next month, the next week. But this is not a short-term investment. This is a long-term investment. So I think I'll come back and say, look, the investors who got capital placed in 2026 are well positioned for the upcoming cycle, that they're getting lined up on the right assets at the right time. There are unique opportunities that are emerging today that won't be there in a year or 2 years or 3 years, because the market will be turning and the competition for those assets is going to be more challenging, and those prices are going to start getting bid up. And so I think that the capital that gets placed in 2026 is going to be very well positioned, despite the uncertainty, despite the challenges that we all face as investors. And it takes a little bit of guts to get out there and say, all right, now is the time to move. Warren Buffett's famous quote, right? When people are greedy, be fearful. When people are fearful, be greedy. And again, right now, I think a lot of the investment capital is cautious. And I think that drives a lot of the opportunity I see in the marketplace.
I love it. John, thank you so much for joining our show again, and specifically for joining me. And thank you to all of our listeners. It was such a pleasure.
Oh, it's so much fun to chat with you. I appreciate it so much.
Amazing. Until next time, everybody.